All right, let's start. We got quite a bit to do for the end of the semester. So I'll do the exam. The exam is whatever the date, the official date, sometime next week. There's the exam from last semester is out there. I don't know if y'all have seen that. So what I'll do, I'll email it out this weekend. We can't officially meet during the study days. So what I'll do is I'll set up a Zoom, which will be my office hours, but during my office hours, I'm going to work that entire exam. If you want to be on that Zoom to ask questions, that's your choice, but it's not a class. I'll record it. So you want, when is our exam? Is it Tuesday or Thursday? Thursday. So yeah, if I do this Sunday night, you'll have, 4 days. So how should you handle the practice exam? Should you wait until that Zoom to look at it, or should you work the entire thing before then? Yeah, work it before then. I always in college, I don't know why other students don't do this. Anytime at a review session, I study for the review session as if it were the exam. And then I would just sit there and only take notes when I needed to. Everybody else was taking notes, and then they get home, now they have 2 sets of notes. And they have to somehow how to integrate these two, but I didn't. I study for the exam review as if it were the exam. That way I can just sit there and listen, like, I know that, I know that, I know that. Oh, wait, what did he just say? I did that wrong. So that's what I recommend. So I'll put that in my email this week. If you can't make the Zoom, then you can just watch the video afterwards and you'll have it. But I'm going to walk through that entire exam. Your exam will look very similar, but just a different company. So there's no reason not to make 100 on the final. I don't understand why any student wouldn't, but the average is usually like 80 to 81 kind of thing. All right, is someone asking me something? Resume. So, all right. So what we have left here is options. So we've got to work through the options. The key are these formulas right here. So you just got to know these formulas. I'm going to do this in Excel. When I do the exam review, I'll actually do it by hand, or I may type it in Word. But this is it. This is the key formula for call options. If you buy a call option, you want to know what your ultimate gain is. We're going to do this at expiration. That's really the key. Watch to see if anyone was following last class. What's the time value of an option at expiration? Any guesses on that? Remember, time value is the value of the option minus the intrinsic value. At expiration, you're going to get the intrinsic value. So what is the time value at expiration? Any guesses? The answer is 0. What does time value do over time? You remember it decays. So at expiration, time value is 0. That's why I'm doing it at expiration. If I asked you to do this before expiration, then you got a huge issue of what's the value of the option with 2 months left or 1 month left? That's the time value. We're not doing that. That's option pricing models. That's binomial models, Black-Scholes models, those type of things. So we're not going to do that. We're going to do it right at expiration. On my YouTube for this, people will click in and say, oh, that's not right. You're forgetting the time value. And I said, no, this is at expiration. So we don't have that issue. Someone's not muted, but I don't see who it is. All right. All right. So at expiration, what is your gain going to be? On a call option, it's the max of S minus X. Y'all remember which one's which? S is the current price and X strike. So if the current price is greater than the strike, you've got a gain. If the current price is less than the strike, what did you lose? All you lose is the price you pay for the call option. All right. For a put option, you just switch that. For a put option, if the strike is higher than the current price, you've got a gain. If it's lower, you don't worry about it. So these 2 formulas is really all you need for this part of the exam. All right, I'm going to do this over and over again to show you how it's going to work. So you can buy a call, you can buy a put, you can sell a call, you can sell a put, you can buy a call and sell a put, you can sell a call and buy a put. And you can own the underlying stock or not own the underlying stock. So you just have to know which one you do. We're going to skip put call parity just because of the sake of time, but don't forget it. It's actually a really cool theory. I would read about it. I love it. It's got some incredible power to it. But we just don't have time, so I'm not going to show you that. But put call parity essentially says if you buy a call and buy a bond that's going to mature at the strike price, that will be the exact same thing as buying the put and buying the stock. And if they're not exactly the same price, you buy the cheap one and sell the expensive one, and you know at expiration they will equal each other. They have to. So you know that's kind of perfect, right? You sell the expensive one, buy the cheap one, so you have inflow, and you know at expiration they're going to be worth exactly the same thing. So at expiration it's going to be worth zero. How much would you do with that? You can cash flow today, and you know in a few months it's going to be worth zero. How much would you do? $1,000, $2,000? What would you do? I do 6.7 trillion if I could. Right? If you know for sure it has to be equal at expiration, then man, do as much as you possibly can. Now I'm ignoring the fact that obviously this could default. So make sure you're in something really, really safe. But if you're in something really, really safe that you know is going to expire, then you know these two have to equal each other. All right, but here's the key, what we're going to do. These are the four you have to know for the exam: protected put, covered call, straddle or strangle. Really, we're going to do strangle and collar. Those are the four you have to know. We'll talk about spreads. We can't really do spreads on the exam because it's just too complicated to do a spread on the exam, especially with different maturities, right? We can't do different maturities because we're doing things at expiration. We can't have two expiration dates. All right. So let's just do it. I don't know if y'all have a company you want to do this on. Who's in the news today? I tell you what, let's do Uber because I've been interested in Uber, and this new virus doesn't have Uber stock doing what I was hoping it was going to do. People are scared we're going to go into another major lockdown. I don't know what the airlines are doing today or what cruise lines are doing today. Have y'all seen them? Are they reacting to this new variant? Shouldn't be a good time. Down 2.45%. Does that look like cruise lines like this new variant? Not much, right? It's pretty bad case for them. Uber the same way. United are they down? Uber's down a bunch today. Yeah, I mean this is Under Armour, UAL. There you go. Yeah. Well, United's actually doing okay today. They are down. I've got a flight on United December 31st. Be my first flight since COVID. So have any of y'all flown since COVID? Is it a different experience?
Not really, you just wear a mask.
On security, you have to take the mask down, I guess, and look at it. So yeah, we'll see. But that's a pretty good drop, right? Boy, that's more than a 10% drop all in one day.
Well,
Wow.
it's only weird here in America. In other countries, it's stricter.
It's stricter, yeah.
Yeah, because when I went to the Middle East in August and September, it was not fun.
Well, the key is, are they going to do the COVID test, which doesn't sound fun to me. I haven't had one yet, so we'll see. I'm vaccinated and boosted and all that kind of stuff, but we'll see what it's like. You know, obviously I can't do a 14-day isolation because I'm only there 5 days, so it'll be interesting. So yeah, I mean, this is not good, but let's look at Uber. So Uber stock, what kind of option do you wish you had on Uber right now? Put option or a call option? Yeah, put option would have done really, really well. So what do you think put options prices are doing today for Uber? Should be up a bunch, right? So I'm clicking on options. We're going to do options. And let's go out to March. March is a good quarter. So you look at the call options and they're down a bunch. you look at the put options and they're up a bunch, okay? So let's do Uber. Uber is currently trading at 37, let's just say 37.70, just so we have round numbers. Also, current price is known as what? S, right? So the current price is, we'll say it's 37.70. I won't tell you what price I bought it at, but. So we need to do, first thing we do is a call option. So we need to have a maturity, and we said the maturity would be 3/20/22. We need a strike. All right, so if this new COVID ends up not being all that serious, what's Uber's price gonna do? Probably jump up pretty much. So one thing I like to do when I'm thinking about this is let's just look and see where the stock price has been. You know, if this all works out, it's been up to 60 bucks. So it's dropped almost in half. And that was just in, let's see, this summer. So we're talking 3 months out, right? So even recently, it was getting close to 50 bucks. So this is a stock that easily could be above 50 bucks. So why don't we try a strike of 45 bucks? Does that sound all right? I mean, would you do a strike of 87 bucks? That seems a little too crazy. It's possible with a firm like Uber, but it seems a little bit too much. All right, and so what I'm going to do on the exam is I'm going to ask you, let's say we went out and bought this call option. All right, so we got to know what the premium is. And then what we want to know is that expiration. When is expiration? March of 2022. All right. What's the time value? Let's see if anybody's paying attention. What's the time value going to be of this option on March of 2022? Zero. All right, so we don't have to worry about that. Does it have time value today? Definitely, right? So how much time value? So let's see. So what did I say? 45 bucks. We're doing a call option. All right, so there's two prices here. There's a bid and there's an ask. We're going to buy a call option. We buy a call option. What price do you think you'll pay? $1.82 or $1.94? $1.94, right? You don't have to know what's bid and what's asked. You just know if you're buying something, you're going to pay the higher. If you're selling something, you'll get the lower. That's a pretty wide bid ask right there. I'm worried that this thing's bouncing around. Is that March? Calls for March, hopefully. $1.82, $1.94. So the bid, the ask, someone remember what I just said? $1.82, $1.94. Pretty wide bid ask. All right, so then we get the expiration. Let's say Uber stock is 20 bucks or 21 bucks up to, let's go up to 60 bucks. All right, let's see, let me think about that. 37, 17 down, 17 up would be 54. So yes, 60 sounds good. All right. So let's look at the stock gain or loss. So you do need to be able to calculate this, but it's pretty straightforward. If the current price is 20 bucks, but we bought the stock for 37.70, what do you think your gain or loss might be? You bought it for 37.70, it's now worth 20. Any guesses on your gain or loss? $17 loss. That's pretty straightforward. And how's that going to move? It's going to be a straight line all the way up, right? So stock price goes up. Just a diagonal line. Not much there. What's the most you can lose if you buy a stock for 37.70? Most you can lose is 37.70. Okay. What's the most you can gain? The sky's the limit. All right. So then let's do the call gain loss. Any formula we're going to use there? Well, the call gain or loss is going to equal, anybody remember it? Without looking at your notes, what's it gonna be? You gotta know this for the exam. You gotta know this for life. What's the formula? Someone yell it out. Well, start with the word max. But yeah, stock price minus, what did you say? Strike. And what? The max of that and what? Zero. Yeah, you're not going to execute at 45 bucks if the stock's trading for 20. That doesn't make sense. You just buy the stock for 20 and then minus your original call premium. So we'll put that in there, equal max. The stock price is 20. The strike is 45. And zero, what's that going to give me? Yeah, so that's the intrinsic value. What's the intrinsic value of a stock that has a strike price of an option as a strike price of 45 when the stock's trading for 20? What's the intrinsic value there? Is it $25 or is it zero? Would you execute this option and buy Uber for 45 bucks if you could buy it for 20? No, so the intrinsic value is zero. But how much did we pay for the option? $1.82 or $1.94? $1.94. So if in this case, what will we do? We'll just lose $1.94. Okay, at what point will we start getting some of our $1.94 back? The stock price has to get to what? If it makes it to 40 bucks, what's our value going to be? What's the intrinsic value if it makes it to 40 bucks? What if I hit enter right there, what's it going to give me? If a stock that's trading for 40 bucks and you have the right to buy for 45 bucks and you paid $1.94 for that right, what's that going to gain or loss going to be? $1.94 loss, good. What about it right at 45 bucks? Well, zero for the intrinsic value, but you paid $1.94. So what you're going to have here? All right, now it gets a little interesting. What if it goes up to 46? So what's the intrinsic value now? You can buy the stock for 45. It's trading for 46. $1 intrinsic value, but did you make money on this transaction? No, because you paid a $90.94. So what should happen if I hit enter here? 94 cents. What about at 47 bucks?
Yeah.
Anybody do in top of your head what the gain or loss there is going to be? 6 cents, right? And then after that, it starts getting really pretty exciting. Now we never make as much money as we would on the stock. If we bought the stock, we might have made $22.30. But with the stock, how much would you have to pay for that stock? $37.70. How much did we pay for the option? $1.94. So which is the better game? Which would you wish you had done? Put all your money into as many options as you could at $1.94, or put all your money into the stock as much as you could at $37.70. I'd much rather have bought the option. All right. What does this? Okay, so $1.94 is going to be our answer all the way back, right? That doesn't change. What sports apparatus is this going to look like? Any guesses?
Betting in Vegas.
A what?
Betting in Vegas.
Betting, but that's not the sporting event I was thinking of. So
Okay.
it's not basketball,
Baseball.
not football, not baseball, even though we have a strike in there. Not a sport we play in San Antonio. They play it in Canada. And hockey, what are they using hockey that might, a hockey stick, right? So if we do the graph, it's going to look like a hockey stick with a really short handle and a long bottom through. But yeah, a call option looks a lot like a hockey stick. The most you can lose is $1.94. But once you hit 45 bucks, you start getting your money back really rapidly. When do you break even exactly at zero? Can anybody do that on top of your head? When will you have exactly a gain of zero? We know it's somewhere between 46 and 47, but where is it exactly? 46.94, right? At 46.94, you'll make $1.94 on the option. That'll cover the $90.94 that you paid. All right, so that's what a long call option looks like. Looks like a hockey stick. It's very bullish, right? Because if the stock price falls, you lose $1.94. But the stock price goes up, you make a fortune. But which is more dangerous? Sorry, oh, I hate this thing so much. You have a lot more downside risk with the stock than you do with the option, but you make more dollar gain on the stock, but you make a higher percentage gain on the option. Same thing on the downside, because here your percentage loss is what, 10, 20, 30%. What's your percentage loss on the call option here? 100%, right? So you got a good chance of losing all your money. If you make money, it's going to be a very levered return. Okay. So this is what we call a long call option. The orange. The long call option versus the actual stock. Questions on that? What's the only thing we needed for this? Max of S minus X comma 0 minus call. Very, very straightforward formula. Now, I said I wasn't going to talk about put call parity. However, if you look at put call parity, a call looks like a put plus a stock. We'll talk about that here in a little bit. So don't forget that. Okay, you're going to see that here pretty rapidly. But let's do a long put. So I'm going to bring Uber back over. So the stock's still trading for 37.70, we hope. Now we're going to do a put option. Now, is a put option bullish or bearish? Bearish. You're hoping the stock price falls. So we're going to get a hockey stick, but it's not going to look like the same hockey stick. So, hey, it come up 7 cents. That's kind of nice. So we're not going to do a 45 strike. So here, what are we worried about? That this COVID thing really takes off. We wish you had done this a few days ago. And if you'd done a few days ago, the SEC probably would have left you alone, because how would you have inside information on that? So what are we worried about? So here again, we're looking at the stock price. We're somewhat at a worst case scenario, aren't we? You know, this is about as bad as it's been, you know, since they first came out. So it's, you know, I don't know what strike you might use here, but it's going to get real expensive to do 35 bucks. We'll try 30. So our premium, we'll go look at that premium. $35 again. 284, 290, a little bit tighter there, 284 and 290. Which are you gonna pay if you buy this put? 290. All right, so I don't have to change this formula very much, do I? The put, what's the only change I got to make? Have y'all gotten this down now? Switch what? Yeah, so it's going to be X minus S and then minus the put, right? So it's the same formula over and over again. All right, let's bring in the same prices here. Why not? The stock gain and loss is exactly the same thing. We just do equal the current price minus the starting price. So that's the same, that didn't change. And here we do the put. Now here, if the stock fell to 20, can y'all do this top of your head? The stock falls to 20. We have a strike of 30. So what's the intrinsic value on this option? Can you do that real quick off the top of your head? You get to sell the stock for 30 bucks. It's only worth 20. What's your intrinsic value? Somebody go for it. Yell it out. If you're wrong, big deal. You have something you can sell for 30 bucks, it's only worth 20 bucks. What's 10 bucks? All right, but we had to pay $2.94 to get it. So what am I gonna get when I do this? The max of the strike minus the stock and 0, that's gonna be 10 bucks. And then I'm gonna subtract what? 294. So what does that sound like? That's gonna be when I hit enter? Yeah, $7.06, right? And that's going to get worse as we go up. At what point will we start losing money? When it goes above 30. Now, when it hits 30 exactly, at 30 bucks, exactly what's going to be my gain or loss? Yeah, 30 minus 30. So the intrinsic value is 0. So if I hit enter right there, what should I get? Minus 294. Now, is that going to change as it goes higher? No, it's going to be 294 all the way down. So what about at $29? Strike price is 30. The stock's trading for 29. So what's my intrinsic value? $1. So your loss is what? $1.94. And then 94. What's it going to be there? 6 cents gain. And then from there, it's off to the races. All right, so what is this going to look like? Another hockey stick, but backwards. Yeah, left-handed. So that's a long put. But actually, I don't want to do that. I always want to contrast it with the stock price. So there's the long put. Very bullish, very bearish. We gain when the stock price falls. If the stock price goes up, we just lose our premium. We're out of it. So what's the most you can make on this one? On the call, we couldn't answer that question, but on the put, you do know the absolute max that you can make on this, right? What happens if the stock goes to 0? Can y'all do that in your head? What's your intrinsic value if the stock goes to 0? Strike is 30. Real close, you went the wrong direction.
Oh, okay, so like 27.6.
2706, right? 2706. So that's the most you can make. You don't have a most you can make on the call option, but you do have the most you can make on the put option. And my break even here looks like it's going to be 2706. And how do we get that? You take the strike minus the option price, and that's going to get you there. So on the call option, the break even was the strike plus the option price. On a put, the break even's the strike minus the option price. All right, so both of these will be on the exam. You'll have to do a long call, a long put. It's just a matter of plugging numbers into a formula. It can't get much easier than that. So you just look at that formula, and the two formulas are practically identical. You just switch the X's and the S's. All right, so can we get a little more interesting here? So protected put, so you got to memorize these. You shouldn't memorize them, you just know them. These are the most common approaches. There are a lot more option strategies out there. There are some really, really interesting ones I think are really interesting. Some of these iron condors and butterflies, some of them are really, really interesting strategies. So we can go pretty crazy on this. Bloomberg, again, the Bloomberg machines, I think they'll let you do 10 legs in the transaction. So that means you can be long the stock, long a put, short another put, long a call, short another call. You know, you can go, I don't know how, I've never done 10 legs on a transaction. So protected put is probably one of the most popular ones. So we're going to buy the stock and we are going to buy a put that's out of the money. The gain on the stock is always the current stock price minus the purchase price. So that's real straightforward. None of the ones I'm doing, we short the stock itself. All right, we're not going to do that. So we either be long the stock or we won't have the stock at all. So on a protected put, you buy the stock and you buy the put. They're both long positions. All right, if you think back to what we just said here, you buy the put and you buy the stock, boy, it's going to look a lot like just buying the call. We'll see that real quickly. It's going to be another hockey stick. Looks like almost the exact same hockey stick as if we bought the call option. All right. The covered call, we're going to be long the stock, but we're going to actually short a out of the money call. I like this strategy. I'm going to talk about when I like it. It's going to look like a horrible strategy because it looks like you can't make much if the stock goes down. You lose a lot of money if it goes down. I mean, you can't make much if the stock goes up, and you lose a lot of money if it goes down. And say, why would you ever do that? And I'll talk about why you would do that. The next one's a straddle or a strangle. We're actually going to do a strangle. A straddle is doing it right at the money, which is really, really hard. You saw that Uber was trading for $37.70. How many options on Uber have a strike price of $37.70? There aren't any. So it's really hard to do a straddle. So a strangle, if you have like a long strangle, you buy the put and you buy the call. You just buy them both. All right. And then a collar is pretty simple. It's just you can combine the first two, protected put and the covered call. So you own the stock, you own the put, and you're short the call. At USA, we did a lot of collars. I was a big collar fan. In fact, at USA, we did, I guess we had 5 legs. We did collars, but with spreads. And my boss kept forgetting we had the spread. I keep having to remind them, why are you doing that spread? And I said, because that's our strategies. Oh, that's not good. My most stressful day at USA was unwinding a spread. Boy, I remember that day. I don't know how I didn't die that particular day, but I had a spread, a put spread, which was going to do really badly if the stock market crashed. And I was watching the market and I kept thinking, man, this thing's breaking down. So I called my trader and I said, I want to close out this spread. But then the market started recovering. So I said, forget it. Never mind. A few minutes later, it started breaking down again. I called him. So I want to undo this spread. Then the market started recovering. I said, forget it. Never mind. Third time I call him. So I want to do this spread. I'm going. He said, are you sure? And the poor guy was new to his job. So he was already stressed out. My other trader had retired and resigned or something. So I said, no, I really want to do it. So I hang up right after that. The stock market crashed. So I'm like, did he have enough time to get this traded? It seemed to me like it was 3 seconds later, but it must have been more than that. So the phone rings. I pick up the phone. I can't remember the guy's name. I can remember the guy he replaced. He's replaced Stewart. But the poor guy was stressed out and he talks to me like, Ron, and it sounds like he's going to tell me we didn't have enough time to get the trade in. And so my heart rate's like 300. He goes, Ron, boy, we just barely got that trade in time. And boy, I literally laid down on the floor. I was so stressed out because that was a few $100 million of a few minutes and a few $100 million. And I mean, that's kind of what 2008s are like. That's what a 2008 year is like. It's like 3 minutes later, we would have been in. So yeah, that was just a really stressful day. I was so glad I got out of that trade. So yeah, these are pretty interesting strategies when markets are falling 5-10% in a day. All right, so let's do the protected put. We've already really done the protected put, haven't we? How would I change? How would I change this to make it a protected put? There's a long put. So I can just copy this whole thing over. And to make this a protective put, I only have to change one thing. So what was the protected put? We own the stock, we're long the stock, we're long the put. What was my protected put? I'm long the put. What's this column right here? Long the stock, right? How do I get long the stock and long the put? What do I need to do? Just add them together, right? Can't get much easier than that. Protective put You just add two together. So on the downside, we lose $10.64. And guess what this number is going to do as I go up? What do you think this next number is going to be? It's a really easy number. You've seen it before. Any guesses what that number is going to be? 1064. What do you think it's going to be here? What's the most you can lose in this option? 1064. What if it goes to zero? What's going to be your gain or loss? 1064. So what the protected put is, it looks a lot like insurance. It's like your deductible. The most you can lose is 1064. Why is that? Well, you're going to lose. Well, let's figure out where that 1064 came from. All right. So our strike is 30 bucks. So if the stock price falls from 37.70 to 30 bucks, how much does the protected put help you? You fall from 37.70 to 30. What's the intrinsic value of the put at 30? And the stock's 30. That's worth zero. So from 37.70 to 30, you lose $7.70. Okay, what else do you lose? You also lose $2.94. Guess what? $2.94 plus $7.70 is. Any guesses? $10.64, right? What's the most you can lose is current, what you bought the stock for down to your strike. You lose that $7.70. At that point, the option starts making you money, but you pay $2.94. So you can't lose any more than $10.64. Now at 30 bucks, what will you have? The strike is 30. The stock's trading for 30. What's going to be your gain or loss there? 10.64. And after that, what's going to happen? Yeah, you're going to start. You're losing at 294 at this point, right? That's worthless to you, but you'll start making $1 on the stock, and you'll still start going up. All right. So what apparatus, sport apparatus is this going to look like? Doesn't that look an awful lot like the long call? According to put call parity, it should look a lot like the long call. A call looks a lot like buying a put and buying the stock. They're almost the identical kind of thing. Pretty cool, right? This is a popular strategy. I don't know if I can get them all in there. We'll see. This is a popular strategy. There's your put. There's your stock, and here's a combination of the put and your stock. You don't make as much money. Anybody want to guess what the difference in these two lines is? It should be pretty straightforward. You might want to guess the dollar amount difference in those two lines. $294, right? This is what you paid. So you paid $294, and you lose that all the way up, but it means the most you can lose is 1064. You can't lose anything more than that. Or you could have just bought a call option. What's the most you could lose on a call option? Well, your option premium, and then you make money on the upside. So they should look very, very similar. The only difference is we don't have that bond in there. But this is a protected put. I like protected puts. See if I can find this file. I can't remember the last time I used it, so I should have thought about this beforehand. Or let's see if I had it in my risk class. I'll show you one. I really let's see. It's one of these. Let's see if it's this one. No, it's not that one. Yeah, it's not that one. I can't remember what this one is though. Yeah, this is a collar. I may show you this one on the collar because I really like this. But one strategy that I find really interesting is for people in their 60s and 70s. What do you normally do in asset allocation? We talked about that on exam 1. If you're getting up there in age, what are you going to do with stocks versus bonds? Reduce your stocks, go to bonds. All right, so a person in their 70s might have 40% in stocks and 60% in bonds. Well, right now, with interest rates so low, that could be a really dangerous strategy, especially if inflation takes off. So if you read my blog, my recommendation is don't go 40% stocks, 60% bonds, go 100% stocks and buy put options. So I actually believe that you end up with a better return and a better risk if you buy 100% stocks and hedge it than if you put 40% stocks and 60% bonds. I actually think that's a better strategy. And how do you do that? So let me show you my strategy. You don't have to pay me for this. This is my strategy. We're going to talk about this in my risk management class because this is my view of the world. It's very, very different than what you're taught. So let's say you think bonds are going to make 2% and you think stocks are going to make 7% and your allocation is 40% bonds, 6% bonds, 40% stocks. So your expected return, you just take 2% times 60% plus 7% times 40%. You're expecting to make 4%. All right, everybody agree with that? Did I do that right? Expect to make 4%. So this is how much you have. I call it my hedge budget. What is my hedge budget? Well, if I put 100% in stocks, what's my expected return? 7%. So I've got 3% to play with here. So I put all my money in stocks. I got a 7% expected return. I can spend 3% of that on hedging and I have the same expected return. You can buy a lot of hedge and protection with options with a 3% budget. So, you know, you have to take my risk class to see this, but I'll show you some actual numbers. I was hoping to find that file, and for some reason I didn't store it. It's out there somewhere, but I don't know why I didn't. Risk management, 2017. Boy, I really do want to show you all that. Yeah, I could find it. Maybe I'll show you next class. So if you go back to 2008, or go back the last 20, 30 years and do this strategy, you'll discover that this strategy versus this strategy. So my strategy of protected put, it's not my recommended strategy, but just a basic, simple strategy. It has a higher return than the 60-40. It's more volatile, it has more volatility, but that volatility is entirely the wrong measure of risk because that volatility assumes you have a normal distribution. If you're hedging something, remember what's the most you could lose here? $10.64. Normal distribution is not what you want because there's no left-hand tail. And so what I look at is not what's the standard deviation, I look at the max loss. And I know exactly what my max loss is if I do a hedge strategy. I don't know what my max loss is. Especially now with interest rates so low, you could lose a lot of money on the bonds. So I like, for senior citizens, I like to say, hey, this is the most you can possibly lose. Over the next 12 months, you cannot lose more than 10%. Would that be comforting to someone who might move into your house if the stock market crashes? Any of y'all want your grandparents moving in with you if the stock market crashes? Like, oh, sorry, I lost too much of my portfolio. I have to move in. Wouldn't it be better to say, hey, most you can lose is 10%. You'll have a better return than you do stocks and bonds. But the most we know we can, for absolute certainty, the most you can lose is 10%. That sounds like a pretty good strategy for someone that age. Where can you do that strategy? The answer is nowhere. No one offers that. At USAA, I wanted to offer a mutual fund doing that. And the lawyer said, no, we can't do that for you. It's too risky. I say, how is it too risky if it's hedged? Why would the lawyer say that's too risky? I'm buying something that's going to protect you on the downside, and they say it's too risky. Why? Because it involves options, which are considered speculative. And that's just the way the SE thinks about it. That's why I hate mutual funds so much. So anyway, if I can find that file, I'll show it to you next time. You can just see how it actually works. It's a really good strategy. But protected puts has this wonderful advantage that you can tell someone with absolute certainty the most they can possibly lose. And you can set these up to mature in a year or even 2 years. And over that 1 or 2 year period, you know that's the max they can ever lose. Now, you'll probably roll it forward before expiration. You can just keep rolling it forward. When would you roll it forward? Well, I would roll it forward when options are really cheap, which is when the VIX is really low. So yeah, I like to roll these things over when it's really, really inexpensive. So I like that strategy. Now, would I do this strategy instead of 100% in stocks? Can you beat the stock market doing this? Yeah, there's no way you're going to beat the stock market doing this. The only way you beat the stock market doing this is if you put this in place and the stock market crashes 80%. Then yeah, you're glad you do this. But on average, over time, I would not recommend this strategy to a 20-year-old. 20-year-olds should just go 100% in stocks and just don't even look back until they turn 30 or 40 or so. All right. That's the protected put. You buy the stock, you buy the put. All you got to do, you've already done the math. So all you got to do is just combine those two things together. So the gain on the stock is the stock price today minus what you paid for it. So the $20 minus the $37.70. So we lost $17.70 there. But we have a $10 gain here minus that. So you do all the math, you know exactly what your gain or loss is. All right, the covered call, we almost have the math for that one. So we had a long call. I'm going to take that and copy it over. All right, so covered call, you're long the stock and short the call. Well, we have that here, kind of. We have the stock, we're long in the stock. We almost have the call. What's the one problem with this call? Well, two problems. First, this is long the call. What are we going to do here? We short the call. And what premium did I use here? Use $1.94. If you're going to sell the call, what premium will you actually receive? $1.82. So we got to make those two changes. So long the stock's already set up. If we buy the stock, we're going to lose $17.70. If it falls, we'll make a bunch of money if it goes up. The call here, we want to change our call premium not from $90.94 but to $1.82 because we're receiving it. So if you're short the call, you receive the lower price, which is the bid. So we copy that down. But here, I can't add across, can I? How do I do the math here? How do you go from long to short? All I got to do is change the signs. So what do we do? Instead of doing plus and plus, you subtract them. So it's plus the stock minus the call. That's all you, if you're short, you do all the math the same. You switch the bid and ask. And if you're short, you subtract. If you're long, you add. Okay. So here, instead of losing $17.70, we only lost $15.88. And why is that? Because we lost the $17.70, but we got $1.82 up front. So we're $1.82 better off. And we're always $1.82 better off until when? The strike is 45. What happens at 45? This call option starts hurting me, doesn't it? So what's the most I can make? 912. And why is that? Well, because we go from 37 So let's think about this. We go from 37 to 45. The call option doesn't help us at all. But at 45, it starts helping us. All right. So from 37 to 45, we're going to make $7.30, but we got to pay the $1.82. All right. So but here we're not paying the $1.82, we're actually making the $1.82. So from 45 to 37.70, we just make the money on the stock. Once we hit 45 bucks, the call option is going to exactly offset any gain on the stock. Those just wipe each other out. All right. So the most we can make it in the stock is 45 minus 37.70. Everybody agree with that? Once we make that $7.30, we can't make any more money on this transaction. But we got paid $1.82. So we make $9.12. All right. This also looks like a hockey stick, but not a really good hockey stick. It's like, who would ever want a hockey stick? So you have all that downside risk, and yet there's a max how much you can make. All right, so that is a cardboard call. When would you do this? And I can only think of one time I would do this, but I think it's actually quite powerful. Let's say your target price for Uber is 45 bucks. You sat down, you've done your analysis. It's trading for 37.70. You think it's going to get to 45. If it gets to 45, you're going to sell it at 45. All right. But what could you do today? Well, you own the stock, right? And you're going to sell it at 45. Well, why don't you go ahead and sell it today at 45 by just selling a call option with a strike of 45? Isn't that essentially the same thing? You're going to sell it at 45. You sell a call option with a strike of 45. What have you essentially done? Since say, hey, when it hits 45, I'm out of the stock. Isn't that what you're going to do anyway? It hits 45. What's the advantage of doing the covered call versus just waiting until the stock hits 45? If you wait till the stock hits 45 and you sell it, what did you make? 45 minus 37.70, you made $7.30. If you sell the call option, what do you make? You make that plus $1.82. You get the call premium. So this is the way to say, hey, we're selling this stock at 45 bucks. You hear someone say that, you say, well, sell it today for 45 bucks. Go ahead and do it. Go ahead and execute this, sell that call option, get the $1.82, because that's something you can't do if you're going to sell it at 45. If you're really convinced that you're going to sell the stock at 45 bucks, go ahead and do it today. All right, there's people that do that on a put option as well. They say, hey, if this stock ever hits X dollars, we're going to buy it. And say, you know what, just go ahead and sell the put option with that strike. If you're going to buy the stock at 30 bucks, why wait until it hits 30 bucks to buy it? Just sell a put option with a strike at 30 bucks. If it never gets there, you get to keep the put option premium. If it gets there, then yeah, you'll start losing money on the put. Well, you would have lost money anyway because you're going to buy it at 30 and it kept going down. So these are really powerful strategies to essentially put your money where your mouth is. If you really believe you're going to sell that stock at 45, then yeah, go ahead and do it now. So that's a cover call. It doesn't look all that appetizing. However, you're going to sell it here anyway. If you're going to sell it here anyway, you would get an extra $1.82, which is really, really nice. As I always say, if you sell an option, you always get to keep the time value. That's always yours. You get to keep it no matter what. That's kind of nice. I can't think of any other reason I would ever do this strategy, because I don't like having all this downside risk, and I sure don't like not having the upside risk. But it's essentially a really, really cheap way to sell a stock today at a price you want to sell it in the future by just, by just selling that call option. Well, your broker lets you do that? Yeah. Your broker has no problem with you doing this transaction, because your broker knows if the stock price, your broker says you can buy the stock, that's fine. Why would your broker let you sell a call? Doesn't that sound really, really risky? Selling a call? But what does your broker know? If you sell a call, that means, hey, if the stock price goes up, you can lose a lot of money. But why is that okay in this case? What can you tell your broker? Hey, this transaction's fine. You don't have any risk. Does the broker have any risk here? So call option, man, as the price rises, you're losing all this money, right? But why is that okay? Because you also own the underlying stock. So it's perfectly hedged. Your broker can say, hey, if you want to buy the stock and sell a call, we have no problem with that. Any loss you have on the call option, it's going to be offsetting gain on the stock. We're perfectly fine. My broker will not let me, because I'm doing a charity, will not let me short options unless I have the underlying. So they will not let me sell call options unless I own the underlying security. Why is that? Because they see that as really, really risky and they won't let that happen. Everybody understand that? Right? This is not your gain, this is your loss because we're short the option. But even though this is unlimited, I mean, how high can we go? What if this stock goes to 5,000 bucks? What's this? We're gonna have a large loss here, right? But what's this number gonna be over here? 912, unless you can't type. Right, so is your broker like freaking out? Wow, you just lost 4,900 bucks on an option you sold for $1.82. So yeah, but I also made 49.62 on the stock. Those two offset each other, not a problem. Would your broker have a problem with you doing this by itself, selling a call option? That's going to make them really nervous. Are they worried about you buying a call option? Would your broker freak out if you bought a call option? Why won't they care about that? The most you can lose is what? That $1.94. They don't care about that. But they freak out if you sold a call option. Yeah, then they're going to be really nervous. They're going to make you put margin aside. But if you own the stock and you short the call, they don't care. That's not a problem for them. They're perfectly hedged. So I have Schwab, which I really like Schwab. I've been using Schwab here. I was forced to use it because USA sold their brokerage business, but I've been really pleased with them. Yeah, they'll let me do these trades, and as long as I have exactly lined up, I can't do, if I have 190 shares of the Uber, they won't let me sell 200 call options. I have to do exactly 190, and we can't do that because they have to be in increments of 100. So yeah, they won't let me do that. But if I had 205, they would let me sell 200 call options. But if I have 199 shares of Uber, they will not let me do 200 call options, short them. They would let me buy 200 call options, but they won't let me short 200 call options. All right, covered calls. So when's the only time I do a covered call is essentially execute a transaction in advance. I know I'm going to sell it to that price. I might as well go and do it today and collect that $1.82. All right. A protected put. Would the broker be worried about that transaction? First of all, you're buying a put, so that's not a big deal. Protected put, even more so, they're probably kind of happy about that because your losses on your stock. So a protected put's not a problem at all, very easy to do. And it's possible if I owned 190 shares of Uber that they would let me do 200 put options because their downside's limited, right? The most they can lose, I can lose is what I paid for the option. So when the brokers get worried is when you start shorting stuff. When you sell the options, sell the put, sell the call, that's when they start getting nervous because you have extremely huge losses that you can. Okay, don't look at your notes. We'll sit here until someone's answered these questions. What is a protected put? In 5 words. Or 7 words. Protected put is what? Long something, short something, long something.
Long to use stock and the put, so you're purchasing one.
Long to stock and the put, and you only need 3 words to that. Long to stock and long out of the money put. Generally, you could do an in the money put, but that would look kind of strange, right? But very good, Tiana. Tiana, that's it. That's a protected put. All right, what about a covered call? Anybody want to try that one? Short to call, you need three extra words. Out of the money. These are both out of the money. Now, I actually like covered calls in the money because you get a lot more premium. So yeah, we did some of those at USA, but yeah, but generally these are out of the money. So you buy the stock and you sell a call that's out of the money. For protected put, you buy the stock and you buy a put that's out of the money. But yeah, that's it. All right. Strangle or straddle. So strangle. So Avi, you got this in our life insurance class, right? We're talking about how annuities are essentially life insurance, and Garrett using that too. Life insurance companies, when they do strangle, when they do life annuities, they're essentially selling the strangle on interest rates. So what does that mean? All right, so we're gonna do a strangle, a long strangle. Avi, Garrett, you remember what letter of the alphabet that looks like? The V, right? So a straddle will look like a V, a strangle will kind of be a V with a little bit of a kind of a bottom to it, all right? So here, there is no underlying stock. So in protected put, you own the stock, covered call, you own the stock, collar, you own the stock, but with a straddle and a strangle, you don't own the stock. You're buying a call, buying a put. Or if you're doing if you're selling it, you sell the put, you sell the call, all right? So we've already got that set up, don't we? Haven't we already done that one? So we've done the call. So what do we need? What else do we need? We just need the put, right? I'm going to call it a strangle, not a straddle. I think most people say straddle when they mean strangle. So I'm just going to call it a strangle. Strangle sounds cooler anyway. Sounds kind of I don't know, hostile or violent, but strangle, I don't know where these terms came from. All right, so everything's already set up, isn't it? We don't, how do we get the strangle?
It's the same as a protective foot.
No, you're thinking the collar. So remember, protected put, you own the stock. Here we don't own the stock. We own the call, we own the put. What's this right here? You own the call. What's this right here? You own the put. So how do we get the strangle? Just add them together. Very straightforward. All right, so let's see if it looks like a V. Kind of. I didn't go far enough out, but kind of a V. Almost looks like a hockey stick again, but we need to go further up. Let me go a little further out so we can. Fix the side of that thing. 36, 12, 21, I went too far. So 21, let's stop it right there. This should look exactly like a V. So there it is. So what are you hoping for with a strangle? You're hoping for volatility. That's your friend. You want the stock price to move a bunch. Because what if it doesn't move at all? What are you going to do? You're going to pay $1.94, $2.94. You lose that. That's pretty expensive. At what point do you start making money? So if the stock goes to 42, we lost, what was our, I put, gain or loss. Let's think about that. What was our strike on the put? Let's see, at 42. My strike on the put was at 35 bucks. So why do we have a gain there? I think that B2 looks right. Does that look right? I might have made a mistake copying these other over. Let's see, long put 45. Yeah, that doesn't look right. So let's figure out. I got the V somehow, but all right. So let's check each one of these. So the call option, do you lose $1.94 if it falls to 20 bucks? Right, the intrinsic value is 0, so that makes sense. What do we say the break even on this was? 45 plus the 194, right? That should give us exactly 0. So let's see if that happens. 46. Yeah, that looks right. So the call looks correct. Let's look at the put. Will we make 2306? So what's your intrinsic value here? So I think I know what the problem is, right? I think our strike is incorrect. So anybody see the problem? What's my put doing? It's referencing my call strike, my call premium, right? What should my strike be? 30 bucks. And my premium, should that fix it? That 706 sound familiar? All right, now let's see it. Now we should still have a V. Oh, well, now we got the bowl shape there. All right, so I went a little too wild, but anyway. So a straddle will be exactly a V because you're right at the money. A strangle will have a little bit of a bowl shape to it because you're out of the money. All right, sorry. So you got to double check these, but this looks correct. So at 25 bucks, our strike was 30, so we make our strike is 30, so 25 bucks. So we make $5 on the put option, but we paid $2.94 to get it, so we make $2.06. So that looks right. On the call, 56. Our strike is 45, so we made $11 minus the $1.84, or not $1.94. We make 906. You're starting to see just off the top of your head. You can start doing this math. It's really not very difficult math at all. The intrinsic value, are y'all getting better at the intrinsic value? It's just the strike minus the price, or the price minus the strike. You can do that in a nanosecond, and then you just got to take the option out. All right, so again, this is a strategy where you're betting on volatility. The stock price doesn't move much. You're just going to lose those 2 premiums that you paid. If the stock price moves a bunch, you start making money. When might the stock price move a bunch? Well, at earnings announcement date. That's when stock prices tend to move. Well, guess what? Guess when the straddle is the most expensive? When it crosses the earnings announcement date. So the market's not like not paying attention. They're like, oh, I had an announcement day. Wow, we should have charged more for options. No, they know that. So that's why I recommend that book, Trading on Corporate Earnings. I can't remember the exact name of it. Trading on Corporate Earnings Announcements. There can't be too many of these books. There it is right there. Earning news. This whole book is how to do strangles and straps. The entire book is based on that. And it's not easy. What you have to do is you have to look at the volatility implied in the stock price, look at historical earnings announcements, and try to see, is the stock market underpricing this thing or overpricing? And based on that, you can decide whether you want to do straddle or not. I had a friend of mine, he was actually a math major, and his dad had him meet me for lunch, and he switched majors to finance. It's like, wow, that's kind of one lunch, have that kind of impact on your family. That's kind of scary. But he was running these type of strategies, and he was making about 10 basis points a day. knowing exactly what his downside was. Anybody want to make 10 bips a day? What is 10 bips a day for 250 trading days? That's a 25% return. Anybody want a 25% return where you have very limited downside? And what was he doing? He was looking at these straddles for firms that had earnings announcements. He's looking at the implied volatility versus historical implied volatility or historical volatility, looking at the earnings announcements. If the market was saying, wow, we're really worried about this next earnings announcement, he probably didn't want to do the straddle. If there was someone understating it, he would also look at the news a little bit to see what was going on. And yeah, on average, he's collecting 10 bips a day with very little. He knew exactly the max that he could lose, right? That's one of the nice thing about a straddle. He knew the max he could lose. So yeah, I don't know if he's kept that going or not. He was going to start a hedge fund doing that. His math was beyond my math skills, so I couldn't really keep up with him. These guys tell you how you can actually do that, how you have to do to look at the historical. You can't just say, hey, I'm going to do a straddle because they're announcing earnings. That doesn't work because the whole market knows that. It's already priced in. You're paying more. So if you buy a straddle that doesn't cross an earnings date, it's going to be much less expensive than a straddle that crosses an earnings date. So people know this. All right. All right. So what I'll do, we'll practice this a little bit more. I might actually just print out the exam from last year, even though, or maybe I won't do the one that I gave you as an example, and we'll do another one so you can practice this. You know, on the exam, you will get a long call. You will get a long put. And you will get one of these four. And I'm going to ask you for the time value. Those are the four things you do on the exam. You have to do a call. You have to do a put. You have to do one of these four. And then you have to be able to calculate time value. So we'll practice that on Thursday because I went pretty fast. So on Thursday, what we'll do it more by hand. There are other strategies out there that are really quite fascinating. Investopedia, Iron Condor. Let's see if you delta neutral. What are you talking about there? Delta neutral. So remember, delta is how much does option strategy move relative to the stock. So delta neutral kind of sounds like it's not related. They actually tell you what is an option strategy consisting of two puts, one long, one short, two calls, one long, one short, four strike prices. So essentially it's two spreads put together. We'll talk about spreads next time too. Do they have an actual graph in here? They don't give you a graph. They should have. Oh, here we go. There's a graph. So it looks a lot like the strangle we just did, but just upside down. So it's essentially an upside down strangle, but an upside down strangle, you would have unlimited loss, right? What to do with the iron condor? It's like you're selling a straddle. Remember, if you sold a straddle, you'd have an upside down V. So you have a lot of downside. What does an iron condor do? Essentially allows you to sell a straddle, but cuts the risk down at the bottom. It's a pretty interesting strategy, right? Most of the time, you're going to make a lot of money. What are you betting against here? You're betting against volatility. Volatility is your enemy here. So, you know, there's a lot of them. There's butterfly strategies and all kinds of stuff. I mean, there's a butterfly spread. All right, I think in the notes, class notes, I gave you some links so you can go for some of these strategies and look at them. All right, so we'll get some more practice on Thursday. So. All right, let's see how many y'all got. So volunteer for one. You can't volunteer more than one, so if you know one, you better volunteer really quick. Which one can you do, Garrett?
That's the call option formula, where the stock price minus the strike, minus the ask.
Minus the premium, okay. So he's only missing one thing. What one thing are you missing? You need another word in there. Well, what if the stock price is 40 and the strike is 50? What would you do? Would you execute that? Would you buy a stock for 50 bucks so you can buy it for 40?
It depends on the ask price.
No, the premium you already paid. You paid that months ago. We're talking about an expiration. So several months ago, you paid $2 for an option. So that's your $2 premium. You're going to lose that. But now it's expiration and you have a right to buy the stock for $50, but it's actually trading for $40. You're going to execute that option? No. So what would you do then? Just let it expire worthless? Worthless is known as what? Zero, right? So, oh, sorry. This screen is just, sorry. I don't know why this computer thinks there's two screens and there's not. So, and it still won't do it. This is very irritating. Just a second. Y'all keep working on it. Screen settings, just a second. Oh man, I don't know what the guy before me does that causes this, but it's doesn't work. Just a second. I still don't know how to do this. I have no idea what they're looking at. No, still nothing. You know what he does, Ashley? Does he have a laptop hooked up or something?
He does it.
Are y'all having trouble with doing this? It just doesn't make sense to me. Just a second. Sorry. This happened before and I don't. No signal, that didn't work. All right, we're back to where we were last time, where I can't see anything. And I have no idea what the people on Zoom are seeing, so we'll have to try it again. Sorry.
We're saying you on Zoom, you can see-
You can't see this?
Yeah. Well, now it's-
Can you see that screen? All right. Sorry, Gary, I can't actually see the screen anymore. So, I don't know what that does. Doesn't work. Was good. Sorry, guys. What other choices do I have? So only one. If I do that, y'all can't see anything. All right, so I have to do this all class. This is going to be really, really irritating. Okay. So what are we missing, Garrett, on yours?
The zero.
The zero plus one word, right? Max, okay? So you either want stock minus strike unless it's a negative number. If it's a negative number, you're going to use zero. All right, Garrett, you're off the hook. Anybody else want to try one?
So your protected or no, your put is going to be the max of your strike minus the stock zero. So if it goes negative, you're only going to lose the put price of the other.
All right, what's the last part
So
of it?
minus the premium.
Premium, all right. And Garrett's right, you know, is it ask or bid or ask? So that's good to know. When you're buying something, it's going to be the higher price, they ask. So, all right. That's two of them. I want to try another one.
The protected put is longest stock and out the money put.
All right, say again.
Longest stock and out the money.
Out of the money, put. All right, that sounds great. Also want to try another one?
Paul, cover.
Sorry. This is really hard to type when you can't see what you're typing.
It's a long the stock and short out of the money.
Good. What else? Strangle, all right. So you just need those 3 words.
At the moment.
Well, I said strangle, right? Not a straddle. Straddle would be at the money. A strangle would be what? Out of the money. And in reality, again, it's really the put call formula, put call parity formula is based on at the money, but it's really hard to get exactly at the money. That's why it's so hard to prove put call parity. Okay. What about the caller? It's got caller. Avi, you got caller? Era, Luke, other Luke.
So would you just combine the covered call?
All right, so put it in there. So would it be?
Combine the protected put and the covered call.
So tell me specifically though,
So you would,
'cause if we did that, we'd end up with 2 stocks a put and a short calls. So you're not gonna have 2 stocks. So it's not quite combining them together. So what would you be?
long stock and out of money put. Short and out of money.
So what else I do? Time value. First of all, what is this formula right here? You may know what this formula, what's another word for this formula? What's another word for this formula? I'll give you a hint. It's 2 words and the initials were I and V. Intrinsic value, right? That's what that formula is, the intrinsic value. So using the word intrinsic value, what is the time value? Anybody want to try that? Hey, Deanna?
The option has minus.
Option premium. What is the intrinsic value? Exactly. So on the exam, when I ask for the time value, oh, sorry, it's so hard to look one way and type another. The intrinsic value is a formula you've already used. Some students like, well, what's the intrinsic value? We just used it 3 times on the exam. So it's the same formula. That is the intrinsic value. That's not the value of the option. Why? Because before expiration, there's time value. So the option is going to be a time value plus that intrinsic value. So if it's out of the money, an out of the money option has what kind of intrinsic value? If you're out of the money, intrinsic value has to be what? Has to be what? Comma 0. Yeah. If you're out of the money, it's 0. So how much the option premium is time value if you're out of the money? If your intrinsic value is 0, then the time value equals what? The premium. So if you're out of the money, all of the premium is time value. If you're in the money, you got to calculate the intrinsic value, and then the time value is the extra amount. Okay. So we got 1 left, and that's put call parity. Anybody remember that one?
Like a long call, right, start.
All right, call.
It's the stock minus the strike price?
There's no strike price in it. You got a call, you got a put, you got the stock, you got a bond that matures at the strike. So that's the only place the strike comes in. So a call equals what? Y'all remember what the call looks a lot like? call by itself looks like which of those strategies? Protected put, covered call, strangle, collar. What does the call by itself look like? You remember the two hockey sticks? The call did that. What else did that? Flat and then went up. Which strategy that if the stock market falls, you can only lose a certain amount, but if it goes up, you start making money. Does that sound like a covered call or a strangle or a collar or a protected put? Which one does that sound like? It's protected put. So what is protected put? A put plus the stock, right? So a call plus what's the only thing I have missing? The bond. So a stock plus the bond equals the put plus the stock. That's the put call parity, and you can flip those all around. I don't ask that on exam, but boy, I think it's a powerful formula to know. So if you know the first two formulas and you know these others, you should be able to figure out everything on the exam, because the stock gain or loss is pretty straightforward. It's whatever the starting price was versus what an ending price is. You just take that difference and then you just plug that formula in. So let's practice. This is an exam question. I don't know which one of these is the practice one I gave y'all. So let's try this first one. You buy a call option on BBY with a strike of 130. The stock is currently trading for 122. So is it in the money or out of the money? You can buy Best Buy for 122 bucks, but you got an option that allows you to buy it for 130. So it's out of the money, right? So what's the intrinsic value? What's the premium? The intrinsic value, not the time value. What's the intrinsic value? So you take the stock price minus the strike, 122 minus 130. What is that? -8, comma 0. So what's the intrinsic value? Intrinsic value is 0, right? Because it's out of the money. All right. You are still struggling with that concept. So the stock price is 122. 122 minus 130 is -8. You do the max of -8 and 0. So the intrinsic value is 0. All right. It's maturing in September. Calculate your gain or loss in dollars on the call option if you're trading at 145 at expiration. All right. So Luke, you did this one. So what if you plug these numbers in what you gave me? What would you get?
Well, your strike price is 130, right? So you have your max, right? So max 130. It's right. Is it no?
Is it S minus X or X minus S?
X minus X.
Okay, so your S is what?
It should be your current price at expiration is 145. Right?
145. Very good.
Minus 130.
Good.
Comma 0.
Which of those options are we going to use?
Well, we're doing a call, right? So we're
Right.
going to do a call option ask price of 620.
Perfect. Very good. You got it. And if you do all of that, what do you get? $15 minus 620. That's like 880 or something. I'm not good at math. If you were looking at me, that looks like about 880. Anybody disagree with that one? So you made $8.80. You could have just bought the stock and made 15 bucks, which sounds pretty good. You would have made more money, but making 880 on a $6.22 investment is 100% return. Where if you buy the stock, you're not making nearly that large of a return. So from that standpoint, it's pretty good. Any questions on that one? You can see how you're just using it. You see why I keep pushing that formula? Because you just keep doing that formula over and over and over again. Everybody see that? Some students come in exam not knowing that formula and they're sunk. There's no way you're going to get these questions if you don't know that basic formula. S minus X, comma 0, or X minus S, comma 0. That's all you need for this question. It's really very, very straightforward. All right, Colin, I think you did the put, right? So plug this into your formula. Or no, wait, sorry, it's Garrett. Garrett, you did this one. Plug this in, sorry.
Oh, is it put?
Yeah, it's a put.
Yeah. So it would be the maximum of the strike price minus the stock price,
Okay,
or 0, minus the ask price.
all right. So what's the strike here?
1.5,
125,
trading at, is that 115?
115.
The ask down there, 1160.
1160. Very good. You're getting it. Now, if I ask you that again in 20 minutes, you still have it?
Yeah, I was, for some reason, I thought it was the minimum since it was call or put, like, don't flip it.
Yeah. Yeah, it's always max because you can't lose money. So yeah, that's kind of a nice thing. All right, so that's what? A loss of 160, it looks like. Is that right?
So there's, so we would just leave it at that, or would we say that?
Well, you don't know it's going to trade at 120.
Oh,
You don't know it was 115 at the end. So at the beginning, you pay 1160, and it looks like you made a good decision because the stock fell $10, but you paid 1160 for that, so you still lost money. But yeah, if you knew it was going to fall to 120 to 115, you wouldn't have done that put. It wouldn't have made sense. But you would still execute this option, right? You at least get your $10 back. You would say, hey, I made a mistake, so let it expire. Well, then you're going to lose $11.60 when you could have at least made $10 of that back. All right. Did we do time value up here? I think we did, right? Time value. Oh, you got this, Tiana. Okay, Tiana, you're on the spot now. So
It's the premium, like, so
we're talking about the put option. The put option,
So the put option premium is the 1160, right?
1160, right? And what was the intrinsic value of an option that has a strike of 125 when the stock was trading for 122?
So you said that when you calculated the intrinsic value by the max equation, right? So it
Right.
would be the 160.
So the max of, so it's a put. So yeah, we're doing it at the time that we bought it, not at expiration. So the time we bought it, the stock was trading for 122, the strike was 125, so it's the max of what minus what?
125 minus 122.
Very good, yeah, 125 minus 122, comma, comma 0. All right. So 1160 minus 3, so what's the time value here? $860. Everybody understand that one? What did we just do? We just used the same two formulas over and over again. All right, so it's just really straightforward stuff. And you can tell professor was doing option pricing in our entry to the investments class. But it does sound really impressive, but we're not doing that. This is just the basic of what do you get at expiration. Option pricing tries to figure out if that 1160 was the right number. Anybody remember what's the 6 things you need to figure that out? Spells Texas video. T for what influences that 1160? How much time? The X, it's the strike, the S, the stock price, the V, volatility, that's the most important one probably. VI, the I is interest rates, and then the D is whether or not it pays a dividend or not. So that's option pricing. We're not doing option pricing. The original Black-Scholes was only Texas VI. There was no D in it. So they had to adjust for the dividends. So we're not doing that. We're not plugging that in. The 2 option pricing models are Black-Scholes and the binomial models. If you take the speculative markets class, they'll do those 2. And you'll spend a lot of time doing that, and you'll probably never do it again the rest of your life. When I buy options, I don't sit down and figure out if the option's correctly valued. I'm trying to figure out if the stock, if Best Buy is correctly valued. When I do options, it's a bet on Best Buy. I'm not trying to figure out if I'm a better option pricer than the market. Guess who's a better option pricer, Ron Sweet or the Chicago Board of the Option Exchange? Probably the CBOE, right? They have a lot of mathematicians there to know what they're doing. All right, let's do it again because I want to make sure y'all got this. All right, so here's a good stock for those in the cannabis business. Not that I'm recommending cannabis. We had an alum who just started a venture capital firm just funding cannabis, so they're doing that. But this, anybody know who STZ is? Constellation Brands, have you ever heard of them? They do a lot of beer, but they're also doing some cannabis. Interesting firm. All right. The same you buy call option, the current price is 214. So at the time today, it's 214. So we have two stock prices I give you in the problem. One is the stock price today. You only need that to figure out the time value. The other another stock price I give you is at expiration. So you get two of those. The expiration, you need to know what the value of the option is at expiration. The 214, today's price is only needed to do the time value. Because we know at expiration, the time value is going to be what? 100% of the time. Time value at expiration, anybody know? Zero, yes. So there's no reason for me to ask you the time value at expiration. That'd be a good trick question, right? How much more is the time value from the time you bought the option versus at expiration? In that previous problem, what would that difference be? If you contrasted that at the time value at expiration, the difference would be what? $8.60. All right, so I could try to trick y'all on that. Okay, anybody want to try this one? I'm not just asking you for intrinsic value at expiration. It's a real simple formula. So any takers? Christopher, Andrea, Eric.
It's not very good.
250, 200.
Common zero.
23, perfect. Yep. So what was that, 2660 or something? If I get the numbers wrong, that's, you know, you'll find out when you teach a class doing math when people are looking at you. It's very hard to do. All right, perfect, very good. Anybody want to do the put?
The max. Max, the 190, which is the strike price,
190, okay.
minus the 170. Almost zero. Minus $7.
710, all right. So it gives us what, 20 minus 710, so 1290 or something. That sound right, 1290? Let me check my work. These getting easier. If we did 50 more of these, you'd be really sick and tired, wouldn't you? My word, this is just so piece of cake. All right, time value. This is on the call option. When you originally did this, the stock was trading for 214. You have a strike price of 200. Can you just in 3 seconds say what the intrinsic value of that is? Without even thinking about it? Strike is 200, current price is 214. And if it's a put, it'd be zero. Yeah, if it's a call option, would you want to buy a stock? I mean, that's what you always ask. Stock's currently trading for 214. Would you want to buy for 200? Absolutely. The stock's currently trading for 214. Would you want to sell it for 200? No. So the put option has an intrinsic value of 0. The call option has an intrinsic value of 14. So we do max 214 minus 200 comma 0 minus what? 2340. Oh, I did it backwards, didn't I? What should I have done?
40 minus.
Yeah. So it's the option premium minus the intrinsic value. And that gives us 940 or something, I don't know. 14. Does that look right? 940? Yeah. All right. So that's it. So what other question when you'll get in this one? You get one last one. Could be a protected put, could be a covered call, could be a collar, could be a strangle or straddle. Won't be a spread, but it could be one of those. All right, can y'all handle that? Well, you just talked about that. A protected put, well, you just look at what the stock price. If we did a protected put on number 2 up here, you already know what the put's worth, right? You've already got that. That's 1290. So what would the stock gain or loss be? It was trading for 214, and now it's trading for 170. You would have lost what? $44 on that. So minus 44 plus 1290. Isn't that all you do? Figure out the gain or loss on the stock, and then if you're long the put, you've already got that calculated there. If you're short the call, you have to change it, right? If you're going to be short the call, like with a covered call, you can't use the 2340, can you? You got to use the $22. So you may have to switch. You can't always do that. So just because you calculated the value of the call doesn't mean you can just use that number if it's a covered call, because then you're going to use the bid instead of the ask. But with the put, it works really, really well, protected put, because you've already calculated the value of the put using the ask price. So you just add that to whatever the stock gain or loss was, and you've got it. All right. Any questions on all of that? Okay, boy, I wish I could. So these two formulas you should be getting really, really good at. And this part of the formula right here, the intrinsic value. So the intrinsic value minus what you paid on the premium, that's going to be your gain or loss at expiration. Here's your put call parity. A call plus a bond equals a put plus a stock. And then those are the strategies that you need to know. And then spread. So what is a spread? A spread can either be a calendar or a strike. So you could do a spread where you buy a call with a strike of 250, but then you sell a call with a strike of 300. That would be a spread with the same maturity. So you might say, hey, actually a better way to do it is if you sell a call, what's the most you can lose? Y'all remember that? I sell a call option on Apple at $200. What happens when Apple price goes to 200? What do you start doing on your call? Start losing a lot of money, right? And what's the most you can lose if you sell a call? It's infinity. So maybe you do a call spread. You say, okay, I'm going to sell Apple. Let's see if we can find Apple here. I think Apple's the largest stock again. They and Microsoft have been flipping around, but I'm going to sell a call option on Apple with a strike of 200, say mature in a year from now. Could Apple go above 200 between now and next year? Yeah, very, very possible. Be kind of unlikely. That's like a 30%, 40% rise, but it could happen. But could it go to $400? Yeah, something major could happen. So what might you do? Well, you sell the call option at 200, but then you maybe buy another call option at 250. So now what's the most you can lose? It's at $50, right? Now, if you sell a call option at 200 and you buy a call option at 250, which option's more expensive? The one at 200 or one at 250? Which will be more value for you? To buy Apple at $200 or buy Apple at 250? I'd much rather have the option to buy it at 200. So when you sell the option at 200, you'll get a much bigger price. We can actually look at that, right? Let's go out a year if we can. So 200, we sell an option at 200, we'll get 1725. All right, someone write that down. Why won't we receive? Oh, I don't know why it did that. why won't we receive 1765? Well, if you're selling the call option, you're gonna get the bid and not the ask, all right? But then if we go out to 250, what will we have to pay? Anybody see that number? That pay 845. I don't know what the chat's telling me. How long ago was that? Can y'all see me, Deanna?
Zoom is
We
not,
only
it's
see
on
the
the.
top one.
Yeah.
Oh,
Yeah.
all right, sorry. Yeah, I can't, yeah, this is like, UTSA should pay me combat pay for their systems. All right, so
There you go.
so what will you pay if you do the 250? So you're gonna receive 1725. What are you gonna pay? You're gonna pay 845, right? You have to pay the ask. But that's not bad, right? You'll receive $17.25, pay $8.45, and if Apple stock hits 190 next year, you made a pretty good chunk of money. Goes to 210, that's kind of scary, right? You're gonna lose that $10, but you made 17, so you're still $7 ahead, but you had to pay to 845, so you're gonna have a small loss. It goes to 250, that's the worst case scenario, right? You lose 50 bucks and you're gonna get to keep all the 17, but you pay the 845s. But if it goes to 500, you don't care. At some point, you got your max loss. Once you go to 250, I'm the kind of person that I don't like shorting anything without putting that cap on the other side. So I would never sell a call option without buying one further out of the money. It's just my approach. And we kind of talked about that with iron condors. That's kind of that approach is, hey, let's not have unlimited loss on anything. And I'm kind of in that camp. So that would be a spread. A second kind of spread is a calendar spread. So you might buy a call that matures in a month and sell a call that matures in 2 months on the same strike, which is going to have the higher price. So if I buy a call that matures in 1 month, let's say January, at 200. So I buy this one, it's going to cost me 240, and I sell one that matures, it's 24 cents, sell one that matures in 2 months. I get $1. I pay 22 cents. I receive $1. That sounds really, really good. The problem is in a month, what happens? That call you bought matures, another one you shorted. But that would be a calendar spreads. So it can work. You just got to be really, really careful. You got to watch it really carefully, because what's going to happen to that 22 cents as you get closer and closer to maturity, it's going to dwindle down. You could buy the $1 one and sell the 22 cents. That makes more sense. So you sell the 22 cents and buy the $1 one. You have some protection, especially if you're doing puts and calls. You buy a put that matures in 1 month and you sell a call that matures in 2 months. If you're doing the caller, remember you're buying the put and selling the call. If you do the caller, it usually makes sense to do the put for 1 month and the call for 2 months. Why? Because you're buying the put, so time value's really going to kill you. I think, no, I said that backwards. Let me say it, do it again. You buy the put 2 months out, you sell the call 1 month out. Since you're long to put, time value is going to kill you, but since you're short to call, time value helps you, and so you keep that transaction going. So that's a spread. Calendar spreads are strike spreads. Now, December of 2008, a really weird thing happened. I wish I could show you. I've never seen this before, but in December of 2008, anything going on in December 2008? Y'all might not have been alive then, but pretty wild market. That's the first time I've ever seen that a 1 month option was trading for more than a 2 month option. And I was thinking, well, I could take my entire net worth and just put it in there, but I couldn't trade because I was a portfolio manager, so I couldn't do it. It probably wouldn't have worked because I wasn't looking at bid ask. The bid asker probably would have killed me. But yeah, I mean, you think about that. You have an option that matures in a month that's trading for $5, and an option matures in 2 months that's trading for $4. There's no way to lose money on that. I mean, it's just incredibly wonderful. So you could sell the one for $5 and buy the one for $4. A month from now, it's either in the money or out of the money, but it's going to be exactly at its intrinsic value. The one that matures in a month later is going to be what? The intrinsic value plus time value. So your worst case is what? You're going to make the intrinsic value on that stock, on that option. So I've never seen that before. The markets are just crazy, but I don't remember. I wish I had the actual numbers so we could actually see those numbers. Are markets closed now? Yeah, it looks like. So while Apple's down today, even though the markets are up, that's kind of strange. How can the market be up 1.4% and Apple be down 61 bips? That's kind of amazing. So let's see. Apple is 268. Microsoft is no. How long was Microsoft bigger than Apple? Was it like for three minutes on one day or something? It wasn't very long, was it? And Microsoft is down today too. Is NASDAQ down? No, NASDAQ's up.
This is down too.
This is a small cap day. This is probably a small cap value day. So, you know, why are techs, when is tech normally sell off? Usually when interest rates are rising, but I don't think that's the case today. No, they are up. So that's kind of consistent, right? Growth stocks don't like interest rates rising. It's only, how many basis points is that? Let's see if anybody remembers. How many basis points is the 10-year treasury up today? Is that 140 basis points, 14 basis points, 1.4 basis points, 0.14 basis points? 1.4 basis points. Is that a big day or a small day? What do we say a big day was? Like 6.5. So it's not that big of a day. That's probably not what's driving tech stocks today. There must have been some news on the new COVID strain that's.
Oh yeah, wouldn't that put more of a bottleneck on like superconductors and stuff like that? So they said that's like the biggest thing. They need more superconductors.
Well, that was a couple of days ago though, right?
Yeah, so with the news, a lot of people are like saying,
Oh.
I don't want to say like a lot of people, but some people are saying, like some investors are saying that the bottlenecks would get worse because of like the COVID, because they could have more lockdowns in some countries are more serious about lockdowns.
So that helps the semiconductors.
No, that would hurt the
Hurt them.
semiconductors, like, so wouldn't that bring the stock price up?
Well, a couple of days ago it should. Today, I think people are reacting that it's not going to be that bad. So today seems more like a recovery. I don't, you know, there's a lot of things going on in markets. The people writing these articles don't know, but they make stuff up. That's why, you know, I'd love to be one of these journalists who just make stuff up. But we really don't know, right? It's how many stocks traded today? Maybe 1-2% of all the stocks. So 98% of the world's not doing anything. So what are we looking at? We're looking at the opinions of 2% of the world, whoever is trading, and what do they think? Obviously, we disagree with them. More of that 2% is going to come in and trade against them. But, you know, what is the market really telling us? And we don't always know that. I love these articles that say something may happen. They had one from Seafield saying oil prices might drop. It's like, well, is that useful information? The price of something might drop. He wasn't saying oil prices, I expect oil prices to drop. He says oil prices might drop in the next 3 months. It's like, okay, well, oil prices could rise in the next 3 months too. But so why are you telling me that something might happen? You know, China might attack Taiwan in the next 3 months too. You know, so what are you telling me? Do you expect it to happen? That's a little bit better. I believe oil prices will fall 10% next. Okay, there you got a forecast. It's amazing oil prices are down below 70 again. All right. Questions on options?
What is the volume? You're looking at options on the finance.
Well, it's the same kind of transaction, although here it's in 100. So these are contracts, not options. So 61 contracts were traded, and each one of those is 100 options. So yeah, you have to do 100 at a time.
Okay,
So that's 61 contracts. Each one of them is 100 options.
so really the premium or the ask price, you have to pay that over 100 shares.
Yeah, if you did this, you'd have to do that 100 times. So that bid of 104, you'd have to do that times 100.
So would it turn into 10,000?
Yeah. That's why it gets tough. I like to use index options when I can, but the S&P is at 3,400. That times 100 is 30 something $1,000. And if I got a portfolio that's only like 200,000, it gets really hard to match it exactly right. But the SPY is trading at what, 350 or 450. So that times 100 is 4,500. So I use SPY so I can more perfectly match my portfolio.
So they're pretty expensive to get into.
Well, because of the times 100, yeah. But usually now with ETFs, so like with the S&P is trading at 4,500. So an option on that, I don't know if we can do options on the, I don't think, well, it does show it. So options on that is going to be, you know, massive. But if you do SPY is what, the S&P 500, but it's 1/10. And so those option prices are going to be 1/10. So it's just, I like to do these type of options because, you know, you've got a portfolio, let's say a portfolio of $100,000 and each you need 2.3 contracts. You can't buy 2.3 contracts. But with the SPY, you need 23 contracts to cover your portfolio. 23 you can do, and then you're not off that much. Or you can do you need 23, or maybe you need 23.5. You can do 23. You can't do 23.5, but at least you can do 23. You know, with the S&P, you need 2.3. That's going to make, if you only buy 2, you're way off. If you buy 3, you're way off. But so you have to wait. It is frustrating. Some of these stocks, you know, think about Google. No, I could tell I typed something wrong. So options on that, these are really expensive options. You want to buy one contract that's going to be $14,000 or $1,400, excuse me. So Google gets a lot more expensive because each option is going to be priced off that. So options are going to be very sensitive to so a stock that has a really high value, their option can be much more expensive just because you have to buy 100 times those versus a stock that's only trading for 42, their option price is going to be much smaller. There's
Do you know anything like Robinhood where you can buy a percentage of a share? Do they do?
I haven't seen that options yet. I've been hearing those, but I haven't. If I was at USA, I'd probably be aware of that, but I haven't noticed that I can do that yet with my portfolio. That would be pretty cool if you could do fractional options. I don't know how that would work without you getting killed on the bid ask, because it gets really expensive for them to break, you know, because the dealer has to cover their risk. You might want to short Apple, but they don't necessarily want to buy puts on or calls on Apple. So they got to cover their book. It's really hard to cover your book if you're doing 23.736. It's just kind of tough. But yeah, I've been hearing more and more about that, but I just haven't gotten into it. Look right there, straddle. Why is that in there? All right. So what more could we do there? Well, if you take a speculative markets class, again, they spend a lot of time on the option pricing models. You probably should be exposed to those at least once in your career, undergraduate. They may expose you to the gamma and the delta and all those kinds of things as well. You might want to be exposed to those. I've forgotten most of that, so Tia.
The Zoom and stuff on that.
Oh, sorry. Yeah, I'll never get that. Someone came in and said, "This is your last class. Let's make it a mess." So Olivia, you have a question? Oh, here's something. All right. So you should be exposed to those kind of things, but do you really need to know that as an investor? Unless you're an option trader, you're probably just going to trust what's out there. So what do you have to watch for if you're an option trader then? And the key is going to be what I focus in on is the bid ask. So the bid ask, that's a really wide bid ask there, isn't it? If I see a really wide bid ask, I get nervous. Now, Garrett, you're asking about the volumes. I'm not as worried about the volumes. There's been many times where I was 100% of the volume. And that didn't bother. In fact, there's been many times where I was 100% of the outstanding. There's times where I had 3 contracts and the number there was 3. And you think, wow, you're the entire market. There's a supply demand. Well, no, because the people trading this on the other side, they have really easy ways to cover their risk, and it really isn't that serious. But I do watch. I'm real nervous whenever I see options that wide apart. They'll tend to be much closer. Wow, look at that. What stock is this? That's a pretty crazy alphabet. Yeah, these are pretty wide. That is a crazy spread. I mean, if you look at a firm like Apple, and go out a little bit further in time, you should see stuff. Y'all see how that's much tighter? 60 cents difference. If that's $3 difference, that's how you tell liquidity, right? If the bid ask is really wide, that means there's not much liquidity. It means the person doing the trade on the other side, they got a tough time covering their book because there's not a lot of liquidity. A lot more trading going on here. 2,000 traded today out of 10,000. You go further out of the money, 2 traded of those out of 32. There's higher volume around round numbers like 150, which makes some sense. Let's see, what did I can't remember what I gave you. And can't remember which one I gave y'all as a link. I gave y'all one, and then it might have been this one. No, but there are some pretty good websites that will go through the different strategies. If I were you, I would maybe Google most common option strategies and know those. That's kind of important to know. Option trading, option. Let's say education. Be a bad place to do it. Well, there's a lot of them out there, right? I'm not seeing the one I want to do. The CBOE is not a bad spot to go. You do have a lot of training. What they don't have on their site is the different strategies. So there you have to go. So in my notes for the class, if I wasn't so blinded here, I would actually go to one of those sites. But in the notes, I give you a few websites that are really, really good. And you can go out and look at them. What I'd recommend that you do is look at them and then go down to the Bloomberg machine and go to the ON function and just start playing with it. Put different strategies in, test it, see what you get, see if it makes sense to you, what you're trying to do. There's strategies that you'll see. I remember when I was doing this, I would look at a strategy, get real excited about it. It's like, man, that would be perfect. I call the option trader and Stuart would say, yeah, but do you think about this? Like, oh yeah, that wouldn't work, would it? Say, never mind. The poor guy, I call them all the time. He's like, what if we go long these two and short this one, but then tricked it? And it's like, no, that won't work. So okay, I tried. So they have education right there. They have videos. They actually even have classes. I don't know how much they charge for their classes. You're invited to a live 60-minute webinar by the CBOE, Stephen Sears and Catherine, to explore the January effect and year-end option strategies. That sounds pretty interesting, doesn't it? Did you know there was a January effect with options? That's kind of interesting that there's even one. How much does it cost? So we click on the button and it probably blows up on me. Meet price. Looks like it's free, doesn't it? Why would it be free? What does the CBOE want you to do? They want you to trade options. Should they charge you money to get a class? Maybe it's free. That looks like a really interesting one. Who's Stephen Sears? Option Solutions. Well, I might go to his website and see what his Option Solutions do. That sounds interesting. Or you might apply for a job there. What does Catherine do? She's at FITSE. He's responsible for product management of market cap weighted equity indices. Who's Matt? He's head of index insights at CBOE. He's probably the moderator. So you've got, boy, the free stuff you have to take. It's kind of like, why do we even have college anymore? Just go teach yourself, right? You don't really need all this, but what I'm trying to do is, we teach you like 0.01% of what you need to know, and you're responsible for all the rest. So if you're interested in options, that is a really good career. If you're really thinking options as a career, Eric Mata, who graduated here a couple years ago, he's working up in Chicago for an option firm. He's more than happy to talk to people about how to get into that career. What should you do? I'm going to try to go see him next year up in Chicago. It can be a career. It could make a lot of sense. The other thing you probably, before you start interviewing, one last thing we didn't talk about, but sorry, which button do I hit? One thing we just didn't get into, and that's hedge funds. So what should you know about hedge funds? We just mentioned them. So first of all, what is a hedge fund? Well, a hedge fund is a private investment vehicle. They're not publicly traded generally. They may be doing some of that, but essentially you're an investor and you're going in this pool of money and you're trusting this person to do whatever they're going to do. You usually have to be a qualified investor, so you have to have a certain net worth to be able to do this. So they can't offer hedge funds to just the general public. But what a hedge fund's going to do? You have that word hedge in there. What does that make you think? When someone says they're hedging something, what are you thinking?
Protection.
Protection, yeah, risk protection. What the hedge really means is they're going to be long and short. That's really what hedge funds do. They're long on stuff, they're short on stuff, and very risk controlled. That doesn't mean they're low risk. It just means risk is what they're focused on. So they're long and short on stuff. So, they may be long the US stock market and short the French stock market. What does that mean? Well, if the world markets all crash, they lose money on the US market, but they make money on France. Depends. If the US falls 20% and France falls 30%, they make a lot of money. If the US falls 30% and France falls 20%, they lose money. But they're somewhat risk controlled and hopefully, we don't always know this, uncorrelated. What's another way of saying uncorrelated, using the word beta? They want to have what kind of beta? Low beta. So that's the two things hedge funds are trying to do. They're trying to be risk controlled. That doesn't mean they're low risk. They may be high risk, but high risk when you're uncorrelated is actually not a bad thing, because they may be up 40% when everything else is down 20%. And they'll generally almost always be short something, long and short something. If I were you, I would know the main strategies before you interview. Especially if you're interviewing with an investment firm, I would know the main strategies. I'll give you a few that I really like. So global macro is a really popular one. Essentially what global macro says is we're going to look around the world. We're going to look at markets, not individual securities. We're going to look at markets. We're going to try to figure out which markets are overpriced and which ones are underpriced. And so what they might be is, like I said, they might be long the US and short France. If they think the US stock market's undervalued and France is overvalued, or maybe long Japan and short UK. They do the same thing on fixed income. They may be long US bonds and short Canadian bonds. They may do the same thing on currencies. They might be long the yen and short the euro, but it's always high level stuff. And they tend to be very, very liquid because they're using mainly futures. They might do commodities as well. And essentially what they're doing is they're going around the entire globe and they're long on what's cheap and they're short on what's expensive, right? And their goal is to be beta zero. So whether they do well or not, it shouldn't matter what markets are doing. It's be uncorrelated. 2008, we discovered they weren't beta neutral. They all were beta positive, which means they all lost a lot of money in 2008. That's pretty frustrating, right? You buy something to help hedge you. The stock market's down 33% and your global macro is down 20%. And you're like, okay, where's that hedge? Market neutral is a really popular one. Market neutral is they usually do what's called, I don't know how to spell neutral. They're usually long, short, and what we call paired trades. If you think you can beat the market, then you should be a market neutral investor. So market neutral investor says, okay, my model says Apple's a good buy and Alphabet's a bad buy. So I'm going to buy Apple and short Apple, Amazon, or what did I say? Alphabet. Be long. I should have picked two with slightly different. So I want to say Google. Can I say Google? Is that all right? I want to be long Apple and short Google. Why am I picking Apple and Google? Why don't I pick Apple and Walmart? Same industry, right? So paired trades, you find two stocks in the same industry, one is overpriced, one is underpriced, you short the overpriced one. And here, not only do we say we want to be uncorrelated, they even have a target beta of 0. That's why it's called market neutral. You don't care what markets are doing, you just care whether they're good stock pickers. So if you think you're a good stock picker, this is what you should do. You're really good at picking good stocks and really good at knowing bad stocks and buy the good ones, short the bad ones. If you're really good, you should be making a lot of money on this. And it costs you nothing. You buy one stock for 1,000, you sell a stock for 1,000, you don't even need any money other than just covering your margins. So it's like infinite return. Sounds pretty good. You might have, oh, I forget what they call it. Well, I'll say almost neutral. Boy, what's the word for that? I can't remember. But there's some that they're long and short, but not perfectly long and short. So they might be 130% long and 30% short. So they're kind of market neutral, but they're not 100%. So they still have a beta of like 0.6, 0.7, but they're not going to go 100 short and 100 long. They're not going to match it up. They're going to buy 130,000. They have 100,000 bucks. They'll put 100,000, 130,000 long, and they'll short 30,000, and then they'll put their 100,000, but be long and short. That'll take some of the risk off, but not as much. There's also this distressed debt, which is pretty popular. You're buying the debt of firms that are essentially insolvent, and you're doing it in a way that you cover yourself. So usually what they'll do is they'll buy the debt and they'll cover themselves with put options or something. So if the stock crashes, they still got some protection. We talked to a guy, boy, he looked like he was 97 years old. He kept coming and talking to us. I don't know how old he was. He just loved what he was doing. He wasn't retiring, but he did distressed debt. And he convinced me that, boy, this firm knows what they're doing. This sounds pretty good. But this would be a great career to do because this is very specialized. This isn't about picking firms that are insolvent that are going to recover. This is all about capital structure. How do you bail this firm out in a way that you can almost never lose? So you're coming in to save them, right? You're going to take all their debt. You're going to take it really cheap, like 5 cents on the dollar, but you still don't want to lose that last 5 cents. So you're going to set up in a way that, you know, if the firm does well, you make a fortune. If it doesn't do well, you cover yourself. Pretty interesting. There's a convertible ARB. That's not how you spell convertible. Convertible ARB. So y'all know convertible bonds. You have bonds that can convert into stocks. What they're doing is they're looking at the value of the bond, the value of the stock, and they're doing long short transactions to try to make you money there. Let's see if Bill Gates knows how to spell convertible. That looks better. Convertible ARB was really popular there for a while, and it's kind of, it just depends on what markets are doing. There's a statistical ARB, which is what does the word ARB stand for? Arbitrage. What does arbitrage mean? You make money with no risk. Right? I talked about put call parity. You find that one side's worth more than the other side, you go long one side, short the other side. Expiration, they're both going to be equal to each other. That's arbitrage. You're bound to make money. Well, statistical arbitrage, I think is really badly worded. It says, if our statistics are right, we're going to make money. That's not arbitrage, but that's what they're saying. Statistically speaking, we should make money on this all the time, but that doesn't actually work. So just go out there. You can just Google most popular hedge fund strategies, and they'll come up, and you'll see these. I'm missing one. I wish I could remember what this one's called, but I think it's just I think it's just called long short equity. So long short equity, yeah, that's it. Came back to me. My memory is getting worse and worse. But long short equity, if you see long short equity, they're probably 140% long and 40% short. If you see market neutral, it's 100 and 100. All right, so that's the distinction in those. This long short equity actually became really popular as a mutual fund strategy there for a while, and then it kind of just disappeared. The reason the long short, and this is the argument they made, which is kind of convincing to me, is what they're arguing is, let's say you really, really hate Apple, and Apple's 8% of the market. How much can you underweight Apple? Well, 8%. What if you don't like Campbell's soup and it's 0.2% of the market? What's the most you can underweight Campbell's soup? 0.2%. And so that doesn't make sense. If I really hate Campbell, why can't I underweight them 3%? So they say Campbell's 0.2 of the market, but I really hate them. How do you underweight Campbell's soup 3% if you're only 0.2% of the market? Well, you short them 3%. So that was the argument. Is it allows us to really execute our strategy so that smaller companies, we can put just as much emphasis on them as we can for larger companies. That makes some sense. I think the reason it hasn't been popular is that it hasn't done all that well. I think it kind of blew up on them. But I don't know if any of y'all Googled that yet. Y'all see any others coming up on your websites? I would do it if I could get back to the website. I don't know, Luke or Anthony or someone Google most popular hedge fund strategies or anything coming up. But I would know the main ones. I forgot. One of my favorites. Managed futures. I'm a big fan of managed futures.
There's one called event driven.
Event driven. That's kind of what you call merger arb. Fixed income arb. There's equity arb, fixed income arb. That's all part of that statistical arb. Yeah, managed futures. I really love managed futures is a trending thing. So global macro guys are saying this is too expensive, that's too cheap. We'll go along that, and we'll short that, and we'll go along this. Managed futures says we don't know what's overpriced, underpriced. We don't care. We're just watching trends. We're watching momentums. We have something that has a momentum. We're going to go long on that. Something that has a negative momentum. We'll go short on that. In 2008, global macro did horribly, and managed futures did great. Why? Because the market's just. I was kind of a managed futures guy myself at UTSA. My stock fund was up a bunch in 2008 because I was doing this kind of strategy. I said, okay, I see the trend. I'm going to jump on it. And it just worked beautifully. So managed futures, why? Because in 2008, things just kept falling consistently, predictably. And so they made a fortune on that. So I really think global macro plus managed futures is a really, really good combination because they are almost naturally diversifying to each other. Merger arb is two firms have announced a merger. And you know, when you announce a merger, the stock price goes up, but it doesn't go to the price. So they say, we're going to buy this stock out at $50. It's currently trading for 40. So what does the stock price do? It doesn't jump up to $50. It might jump up to $47. So if you buy that stock and the merger happens, you make $50. The merger doesn't happen, you're going to fall back down to 40, you lose $7. Merger arb is taking advantage of those mergers and trying to get that extra $3, right? Between what the stock jumps up to versus what the actual price is. Again, the word arb doesn't make any sense because there's no arbitrage here. You can still lose money.
They have one called a short only.
Yeah, short only. I don't know why. I've never heard that one as a hedge fund strategy. There are certainly mutual funds that do that, right? So I guess it's possible. I mean, you should be really long short because short only definitely has exposure to the market, right? If you're short the U.S. stock market, you got a beta, it might be -1, but that's still a beta that's pretty. So what these guys are trying to do, so -1 beta doesn't make it exciting because you're definitely exposed to the market. You want a 0 beta, you want something that diversifies your portfolio. -1 beta, you're just essentially getting out of the market. All right, so that's it for the semester. I haven't figured out yet when I'm going to work the practice exam, but I'll do it and send out the Zoom. If you can't make it, you can watch the Zoom. Some of y'all I'll see next semester, I know, because you're in my risk class. We will have the final exam in this room at the scheduled time. If I don't see you again, you know, I am your professor for life, so you're always welcome to call or email me with questions. Don't send me an investment and say, should I do this investment? Because I don't give that kind of advice. You're on your own. But I wish you all the best, and I'll see y'all around hopefully.